Thanks to blockchain technology, DeFi or decentralized finance is making a major push to move some of the aspects of traditional finance onto a decentralized platform. One aspect of centralized finance, however, or CeFi, that you might not think that DeFi can replicate is lending, where traditionally the history of a borrower is looked and judged to see whether or not they are going to be capable of repaying a loan. However, AAVE seem to have managed to solve this problem and do it in a decentralized way. So stick around and let's talk about it. Hey guys, I'm Sprag, and I guarantee that not many of you who've been around in this scene for very long can think of any ICOs that came out of the 2017 boom that have actually stood the test of time. However, AAVE or ETHLend is one of those projects that has actually managed to continue to forge ahead despite the market crash. In fact, the creator Stani Kulachov actually said that the 2018 bear market was one of the best things that happened to AAVE because it gave them the opportunity to go back and rethink their model for decentralized lending. This is because originally the problem with ETHLend was the fact that there was illiquidity, which means that there wasn't enough liquidity to provide the loans that the platform was offering. And that meant that once the 2018 bear market happened and the markets died down enough, it gave them the opportunity to completely revamp and redo their model, which then allowed them to come out with AAVE, their updated and much improved version of their lending platform. AAVE meaning Ghost in Finnish, which alludes to the fact that everything on AAVE is completely transparent, including the code which is open source. AAVE aims to drive interest into the crypto lending sector by providing lending, borrowing and interest earning on crypto assets. The system works similarly to how the CeFi system does, however completely autonomously, where there is no one in the middle making judgment calls on whether or not someone can borrow, and where the code that runs this entire thing and dictates the interest rates is completely open source and viewable by anyone that wants to scrutinize it. I think most of us here in the crypto space are here because of some level of distrust or dislike to the traditional finance sector, and to be honest, it's quite easy to see why. For example, if we take the CeFi version of lending, you put your money in a bank. Your bank will then lend that money out to borrowers. But the thing is that while they're making if we use the UK averages, 6% return on the interest on those loans, your bank account will most likely only offer you around a 0.1% interest rate. Now, obviously, this does oversimplify the problem a little bit because the bank is taking the risk that the borrower will default on their loan. However, if we take Bank of America in 2017 as an example, they made $58 billion purely from interest on loans. Now, when you consider the fact that they were only paying out 0.03% to the bank accounts whose money they were actually using to lend that money, this doesn't even cover the rising cost of inflation, let alone actually make it worthwhile holding that money in a financial institution. So with crypto becoming a burgeoning alternative financial sector, it makes sense then that we would aim to try and replace this traditionally CeFi act of lending and borrowing with a DeFi alternative. And this is exactly what AAVE and its ERC20 token and smart contract aim to do. Using the AAVE ecosystem, anyone can lend a variety of ERC20 tokens in a completely trustless and permissionless manner, allowing them to earn interest in real time directly in their crypto wallet. However, to actually understand AAVE, first we do need to understand liquidity pools. A liquidity pool is a collection of a particular token locked inside a smart contract on a particular chain. If we use the example of something like Uniswap, which also uses liquidity pools, and we take the CeFi equivalent of that action of taking one token and converting it to another. In the CeFi equivalent, if we wanted to, for example, buy some BAT, our buy offer would be matched with a equivalent BAT sell offer. Now, the problem with this is that on, for example, the Ethereum chain, which is the most used chain for DeFi, the gas fees would make this prohibitively expensive to try and do this in an autonomous manner. And this is where autonomous market makers, or AMMs, come in and completely shake up the game. By having the required tokens to fulfill a loan already locked within the smart contract or liquidity pool, it means that the AMM can then immediately offer that loan to the user that requests it. In this case, the term liquidity, which you might have heard a lot in the crypto sphere, is just a term for how readily available a token is for swapping or purchase. For example, as I mentioned, one of the biggest issues with ETHLend, the predecessor to AAVE, was its illiquidity, which means that there was so many people wanting loans due to the fact that they are essentially a way to leverage trade, and not enough people actually providing liquidity that a lot of the loans weren't going through. I will be doing a video focused solely on DeFi liquidity pools and yield farming in the future, so if you want to get notified when that happens, hit the subscribe button down below. But for now, this is enough to understand how AAVE works. There's three main components to the AAVE ecosystem: the liquidity provider, the borrower, and the smart contract that ties them all together. So let's start with the liquidity provider, or lender. AAVE has a variety of tokens that can be lent or borrowed within its ecosystem. These include ETH, BAT, MANA, and a variety of stablecoins such as DAI. A liquidity provider or lender will then deposit one of these tokens into its respective liquidity pool. Upon doing this, they will receive an A token in response. These A tokens are one-to-one backed tokens to the token that they have deposited. For example, let's say that I had 5 Ethereum that I wanted to earn some interest on. I could deposit my 5 ETH into AAVE's ETH liquidity pool, and in return, I would receive 5 AETH. Now, unlike, for example, Celsius or BlockFi, which are centralized lending platforms that will pay you out weekly or monthly, depending on their payout rate, by holding an A token within your wallet, they will accrue interest in real time. You can literally see the balance increasing by looking at your wallet. Personally, this and the fact that the code is open sourced and you are not trusting your funds to an unknown party, such as Celsius or BlockFi, makes this a massive benefit in my opinion to go for a service such as this if you do want to earn interest on your crypto. But now, let's say that I want to get my ETH back. Well, I can now redeem my AETH and convert it back into Ethereum. So whichever amount of AETH I have accrued over the course of my interest holding, I can now redeem that for Ethereum. The AETH that was given to me when I deposited my ETH is minted upon deposit and is burnt upon redemption. Now, this may seem like free money, but in my usual considerations and concerns section near the end, I will go over a few things that you need to know before you throw all of your ERC20 tokens into an AAVE liquidity pool. But for now, let's look at borrowing. As a borrower, you can offer up any one of the accepted tokens on the AAVE network and receive any other token as a loan. This means that a borrower can get exposure to crypto that they didn't previously own by offering up any one of another token as collateral. Then, similar to a CeFi lending platform, a borrower can then take out a variable interest or fixed interest loan for a specified term. Really, this side of AAVE is the easiest to understand. You put down crypto as a collateral and you take out a loan. Now, there is also the AAVE token, and if you put this down as a collateral, you can then get a discount on the fees that you need to pay for taking out a loan. This is just one of a few uses for the AAVE token. However, since this isn't its own chain and a lot of the facilitation is in crypto lending and borrowing, the AAVE token doesn't have as much of a use as a lot of other platforms. Now, this is where we get into the smart contract itself. Being an entirely autonomous system, the entirety of AAVE is driven purely by its smart contract. This means that when choosing interest rates and prices, it's all done formulaically, where, for example, if there is a low amount of liquidity in a particular pool but a high demand for loans, the amount of interest offered for providing liquidity will increase, while also the interest rate for taking out a loan will also increase because it's in higher demand. The aim of this is to try to solve the illiquidity problem by enticing liquidity providers to offer up their ERC20 tokens when they see a good interest rate. Now, another big selling point of AAVE is the fact that it offers flash loans, which are a major technological advancement. However, flash loans are very complicated, and honestly, I don't think I can do them justice in this video, so they will have their own segment in my upcoming DeFi video. But now, it's time for my concerns. Firstly, due to the fact that no background history is known on a borrower, and no sort of credit score or anything like that is judged upon, it means that the collateral needed to take out a loan is very high. This makes it a very capital inefficient system, whereby a party would need to already have a large capital to be able to take out a loan, which shuts the system out for smaller parties. Secondly, even though AAVE's code is audited by a third party, at the end of the day, it's still just code. And as a software engineer, I can attest to the fact that I have written what I believe to be bulletproof code only for it to completely fall over because of a series of weird events that even the unit tests couldn't catch. This becomes a paramount concern when you consider the amount of money that is on the line. And you may have heard in the news recently about the fact that other lending platforms have actually fallen victim to flash loan attacks. I will admit, however, that this isn't necessarily a concern with AAVE and more just a concern with smart contract-based lending platforms. And finally, AAVE is much more confusing than its competitor Comp. This is due to the fact that it's newer to market and therefore has managed to implement a lot of newer features and a much greater token pool than Comp has. However, this could put off newer investors who are looking to get into yield farming who may go for the easier alternative. However, saying all this, AAVE is an extremely promising platform. And the thing is, they have done some great marketing this bull run to bring them right up there with the big dogs when it comes to creating a DeFi lending platform. So really, I do think that the future is incredibly bright for AAVE. This and the fact that DeFi is slowly gaining more and more attention with real-world organizations means that at some point we could see AAVE being adopted as the crypto lending platform by these companies who want to start taking advantage of the crypto space. I hope you guys enjoyed this one. I know that DeFi can be very, very confusing and the learning resources on it are kind of sparse, so I'll make sure to follow this up with an actual video on it. However, I really enjoyed learning about AAVE. It is a super promising project and one that I can see many people getting into in the future. If you did enjoy the video, please leave me a like. If you want to critique or give me a comment, drop it down below. And if you just generally enjoy my content, please consider hitting the subscribe button. Thanks. Bye.